Credit Suisse had 382 warnings. Then the bank run began, or fiantation. Credit Suisse was a Swiss global bank, a company that took deposits, managed rich clients' money, and financed corporations through investment banking. It was based in Switzerland, a country whose reputation for private banking made trust almost a national export. For 167 years, Credit Suisse mattered because it connected wealthy families, governments, companies, and markets across the world. If a bank like this looked safe, clients left billions inside it. If it looked unsafe, those same clients could move money out with a few phone calls and app taps. This video is about how that trust was lost. Not in one weekend, and not because of one unlucky trade. From Tidjane Thiam, the chief executive who left after a spying scandal, to Ulrich Kerner, the final chief executive asked to rescue an already damaged institution, Credit Suisse's collapse was written through repeated leadership choices. The rise. To understand the fall, we first need to understand what Credit Suisse was trying to be. It was not just a quiet Swiss bank with vaults and polished marble. Over time, it became a global financial machine. Its wealth management business served rich clients. Its investment bank made deals, traded securities, and lent to hedge funds and companies. That combination promised prestige and profit. Stable private banking money on one side, high-powered Wall Street-style returns on the other. The ambition was simple. Credit Suisse wanted to compete with the biggest global banks while keeping the aura of Swiss safety. That aura gave its executives room to chase business around the world. Clients believed the brand meant discipline. Regulators expected control. Employees saw a firm where big risks could bring big rewards. For years, that model seemed to work well enough to survive even major setbacks. During the 2008 global financial crisis, when banks around the world were under stress, Credit Suisse received a $5.3 billion bailout from the Swiss government, backed by a loss guarantee of 10 billion Swiss francs. It survived. And survival can teach a dangerous lesson. If a bank keeps escaping, leaders may start believing the institution is too important to truly break. Warning signs. The first cracks were not hidden in complex spreadsheets. They were public, repeated, and embarrassing. In 1999, Japanese authorities fined Credit Suisse and revoked a license after a so-called shredding party, where bankers destroyed evidence during an investigation into concealed losses. In 2009, the bank paid $536 million for deliberately bypassing United States sanctions against countries including Iran and Sudan. In 2014, Credit Suisse pleaded guilty to helping Americans evade taxes and faced a $2.6 billion penalty. Each case pointed to the same basic problem. Profitable business was being allowed to outrun controls. A control is a safeguard that stops a bank from taking illegal or reckless risks. At Credit Suisse, those safeguards kept failing in different countries, different businesses, and different decades. Then came Mozambique. Between 2012 and 2016, Credit Suisse helped arrange more than $2 billion in loans to state-owned companies in Mozambique, a country in Southeast Africa. The projects became known as the tuna bond scandal because they were linked to a fishing fleet and maritime security plans. Much of the money was diverted through bribes and kickbacks. More than $200 million in bribes went to Mozambican officials and Credit Suisse employees, including Andrew Pearce, Surjan Singh, and Detalina Subiva. In 2021, Credit Suisse admitted to defrauding United States and international investors and was assessed more than $547 million in penalties, fines, and disgorgement, meaning money it had to give up because it was improperly earned. The bank could still say these were old problems. But the new problems were arriving faster. Transition to the leadership crisis. By 2020, the question was no longer whether Credit Suisse had scandals. The question was whether its leaders could still command belief inside their own building. Tidjane Thiam, the chief executive from 2015 to 2020, had been trying to reshape the bank. His tenure ended abruptly on February 7, 2020, after a spying scandal. Credit Suisse had hired private detectives to follow Iqbal Khan, its former head of wealth management. After Khan left for UBS, Credit Suisse's larger Swiss rival, Pierre-Olivier Bouet, the chief operating officer and a close ally of Thiam, was fired over the affair. Later, Switzerland's financial regulator, FINMA, said Credit Suisse had misled it about the scale of the surveillance and had planned 7 spying operations between 2016 and 2019. That detail matters because spying on a former executive is not a normal banking error. It suggested a leadership culture where internal rivalries and secrecy had become operational risks. A bank that should have been measuring credit exposure and client money was now explaining private detectives. The collapse. The final collapse began when old cultural problems turned into immediate financial losses. In March 2021, Greensill Capital, a British finance company, collapsed. Greensill specialized in supply chain finance, which means lending money against invoices that companies expect to pay later. Credit Suisse had marketed funds linked to Greensill with low-risk indications, and clients had invested around $10 billion. The warning signs had been there. Credit Suisse had been warned against dealing with Lex Greensill's company as early as 2018. By 2019, the bank knew its funds were overly dependent on a small group of insurers, companies that promised to cover losses if borrowers did not pay. Yet the problem was not fixed. FINMA later found that Credit Suisse seriously breached its supervisory obligations over several years. One concrete moment captures the culture. A senior manager overruled a risk manager's recommendation not to grant a bridging loan, which is a short-term emergency loan, to Greensill. That same month, another disaster hit. Archegos Capital Management, a United States family office, meaning an investment firm managing one wealthy person's fortune, defaulted on highly leveraged stock bets. Leverage means using borrowed money to make a bet bigger. Credit Suisse lost $5.5 billion. Here, the numbers were brutal because the reward had been tiny compared with the danger. In 2019, Credit Suisse made only $17.5 million in fees from Archegos, despite exposure to a potential $20 billion loss. A committee had identified issues with Archegos as early as September 2020, but failed to set deadlines or assign owners for recommended actions. The chief executive and chief risk officer only became aware of the bank's exposure in the days before the forced liquidation in March 2021. An independent review later called it a fundamental failure of management and controls in the investment bank and said the business had enabled Archegos' voracious risk-taking transition to the last rescue attempt. After Greensill and Archegos, Credit Suisse needed a credibility reset. Instead, leadership kept turning over. Antonio Horta Osorio, a Portuguese banker hired as chairman in April 2021 to repair the bank's image, resigned after just 9 months. An internal investigation found he had broken COVID-19 quarantine rules in Switzerland and the United Kingdom, including attending Wimbledon. For employees and clients, the message was corrosive. Even the person brought in to restore discipline was leaving over a rules problem. In 2022, the bad news kept accumulating. The Swiss secrets leak revealed that Credit Suisse had provided services for decades to human rights abusers, corrupt politicians, and sanctioned businessmen. In June, Switzerland's Federal Criminal Court found the bank guilty of failing to prevent money laundering by a Bulgarian cocaine trafficking ring between 2004 and 2008. The fine was only 2 million Swiss francs, with another 20 million Swiss francs ordered paid to the government, but the reputational damage was far larger. That July, Ulrich Kerner replaced Thomas Gottstein as chief executive and launched another transformation project. But a transformation plan needs time, and Credit Suisse was running out of trust. In the fourth quarter of 2022, clients pulled out 110.5 billion Swiss francs in assets because they were worried about liquidity, meaning the bank's ability to meet cash demands. For a bank, outflows are not just a bad metric. They are clients voting with their money. By early 2023, the situation was fragile. Credit Suisse reported a full-year net loss of 7.3 billion Swiss francs for 2022 and warned of another substantial loss in 2023. Then the United States Securities and Exchange Commission, the American market watchdog, delayed the bank's annual report over a technical assessment of revisions to cash flow statements from 2019 and 2020. Soon after, the bank admitted material weaknesses in financial controls, and its board ended board bonuses. The final week moved quickly because confidence had already been drained. On March 16, 2023, The Swiss National Bank, Switzerland's central bank, offered Credit Suisse a 50 billion Swiss franc liquidity lifeline. In another era that might have calmed clients. This time, it did not stop the run. On March 19, 2023, UBS agreed to acquire Credit Suisse in an all-share deal worth 3 billion Swiss francs. Credit Suisse shares were valued at 76 centimes each, 59% below their previous close, and less than one-tenth of their value when Thiam left in February 2020. A 167-year-old institution was not allowed to go through a normal market death. It was forced into the arms of its rival to protect the wider financial system. Lessons. The lesson is not that every scandal immediately destroys a bank. Credit Suisse proves something more dangerous. Scandals can become survivable enough that leaders stop treating them as existential. FINMA later said the bank failed because of shortcomings in strategy, management, recurrent scandals, and the loss of client and investor confidence. Between 2018 and 2022, FINMA conducted 108 on-site reviews, found 382 points requiring action, and classified 113 as high or critical risk. Those numbers are the clearest epitaph. Credit Suisse did not lack warnings. It lacked a culture that forced powerful people to act on them. When risk managers were overruled, when committees did not assign responsibility, when bonuses stayed high, even in loss-making years, the bank was spending trust it could not replace. So the final collapse was not just a bank run. It was the moment clients, regulators, and the market finally stopped believing the next apology, the next chairman, or the next restructuring would be different. In banking, trust is capital. Credit Suisse spent decades losing it, and in March 2023, the bill came due.